Good morning. Welcome to the morning market briefing. Today is Friday, April 17th, 2026. I hope you're doing well. I have a lot to get to today. Excited to talk a little bit about some turnover in the tech world, a little bit about what's going on in the Middle East, and then give a preview of next week. So it should be a really nice, interesting week next week with a lot of earnings reports and obviously the Kevin Warsh confirmation hearings as well. So, Tom, let's just jump right into it. Want to talk a little bit about some more, I guess, tacking to the middle by the president. We've talked a little bit about this before. You can call it tacking to the middle. You can call it tacoing to the middle. But the ICE director, Todd Lyons, he's going to be leaving at the end of May, ending a pretty interesting 15 months tour of duty as the ICE director. This comes on the heels of the new DHS secretary. So you've seen a total turnover in that position. I think they accomplished what Trump wanted them to accomplish, and now they're no longer, politically advantageous to his midterm election hopes. So we've got that going on one side, and on the other side in the Middle East, Trump appears to be fairly optimistic about what's going to happen over the next couple of days. Already there's been a ceasefire, 10-day ceasefire agreed between Israel and Lebanon. But Tom, talk a little bit about what you think is going on in the Middle East. It does seem like the market's pricing in some favorable developments. Oil down this morning, stocks continue to be up. Haven't seen much movement in bonds, though, and I do wonder if bonds are telling the story here, and we should be a little bit more wary about any sort of peace deal.
Well, I think it's interesting because the oil scare, there was not a flight to safety in bonds. And now we flip the other way where high vol, momentum stocks, things that had been sort of dead in the water to start the year, even software, the last couple of days has been hot. And so I think what you didn't have was people flipping from equities to bonds. What you had was basically going to cash. And now you're seeing that cash flow back to the same equities we've seen outperform for the last 5 years. So I think it's almost like you didn't even see that reaction, and so like there's not a lot of demand for bonds because suddenly everyone wants to jump back in the stock market. And I think that's driving it more than anything. I mean, you can't say that it's still elevated because of the war in the Middle East because, WTI is at 87 right now, and then Brent is at 95. So the big oil scare is kind of gone. Natural gas prices have actually fallen in the U.S. and risen everywhere else.
How much is oil down this morning then?
Let's see.
Like it's gone down
about
further.
3.7%. So, that's a
87. We were at $115 a barrel just a week and a half ago.
Yeah. So like all the $200 barrel and the summer is going to be miserable is going away. So all of the short-term transitory inflation that we will see on the next couple prints will be gone, assuming that this sticks. And so I think that it's almost like because there was no buying, there's also been no selling, and so we're just sort of going sideways. The MOVE index is cratered. The anticipation of further volatility in the bond market is basically dead, but that goes both directions. That includes dropping. And then, of course, we don't have any real read to reset potential rate cuts.
There's no FOMO in bonds. There's no fear trade of people rushing into bonds. There's no scared money in bonds right now. People aren't aggressively selling, but there's no FOMO that this is going to be the last time you see these yields because you're not being, you don't have the leverage being applied by the Fed saying we're going to cut rates.
So there's really there's no natural driver to bonds right now, which I think is a great reason to buy them. The last couple of days, we've been sort of trimming out of equity positions that have rocketed up that we were buying a couple weeks ago when the market was sold off. Now they're up double digits, and some of that is just selling and going back into bonds. This just playing the asset allocation. There was one morning, I can't even remember what morning it was in here, but Ben and I were in, and we were complaining that the young boys weren't butts in seats because those are the times where you can make that extra performance for clients because the market was down like 2.5% that day. And I was just quickly going through client accounts and primarily in IRAs, just buying SCHX, which is the free Schwab S&P 500 ETF, with the idea being we just got to get money into equities. The market's down so much, we need to trim bonds and buy stocks because the market's down so much. And by the end of the day, I think we finished down 40 basis points. So it was a big swing. And now, fast forward 2 weeks later, we're up 10% in those positions. You can just exit those because now you're overweight equities. And the easiest thing to trim is an ETF that you don't typically hold, and it's in a tax advantaged account. You're out and you can buy bonds, which have not moved at all.
Would this be a fair characterization, Tom? Because people like to talk about bottoms in markets or tops in markets. In the stock market, obviously, we've had a recent history, but even this is true anyway. It's an escalator up, elevator down, and then when you do hit the bottom, it tends to be a really rapid bottom, and it kind of V's out of that. The stock market, not the economy. And then the tops tend to be a little bit more like processes and things that kind of glide along for a little bit, starts to get heavy, makes a lower high, and then starts to roll over. That's kind of what we see in the stock market. And then it bottoms in V's. The reverse seems to be true in fixed income. And that is interest rates stay high for a longer period of time. They kind of work their way around. People kind of forget about it. There's no real excitement in the market. And then when people actually get excited, the tops of the bond market or the lows in interest rates are more V-shaped. And we saw that in 2020. I think we saw that maybe in even 2008, certainly 2011.
Yeah.
But talk to me. Would you agree with that characterization, or do you think it's more nuanced than that?
I mean, the guy I learned to trade bonds from always said that bonds move in a sawtooth fashion. So, you'll get a big up and then it'll like a sawtooth across. So there's a big down and then a sawtooth across. And so you need to be careful of those big moves because that's when you lose money as an active trader in bonds, which is that you bought a bunch of stuff, suddenly bang, you get a 15 basis point pop on the 10-year, and everything you own is now underwater. And you've got to have homes for those bonds. Otherwise, your inventory is eaten up, or you have to sell those for a loss and you're not making money that month. So that's kind of how you have to play it, and you have to be more cognizant of those big moves than you have to be of the sawtooth, because if it moves sideways for a while, you can make money all day long. And so perhaps that's how Goldman got popped, and in the reverse scenario, JP Morgan did so well on bond trading this month, is that in inventory management and being cognizant of hedging that risk, because when you saw a big move, you can either make a ton of money or lose a ton of money, and it depends on how many bonds you're holding at that time. Just on the transaction side, because it's all about volume and how much spread you can make on each bond you buy. So, yeah, it's one of those things where the bond market is either really in focus or it really isn't, and suddenly no one's paying attention to bonds anymore because Merry Christmas, the war is over, oil prices are falling. But the problem is they sold off for, I'd argue, false reasons, which is the Fed is not going to cut. I still think they are. Oil was going to $200. It didn't. But now all of the focus is switched back to why is Allbirds.ai, a shoe company turned AI company, up 700%. I mean, I've gotten a million questions about that. People text me about it. Should I get in on this Allbirds thing? We're suddenly back into a full risk on scenario, and that doesn't equate to bond buying.
I did have a call with a client yesterday, and they asked, why would I own bonds here? I think I feel like I need to be risk on. And why would I own bonds? I mean, I'm concerned about inflation. I'm concerned about the labor force shrinking. And I said, well, this is exactly why you want to own bonds. They have first of all, they have a positive expected return. People take that for granted. They didn't have a positive expected real return for the last 20 years. And now they have a positive expected, call it 2% real rate of return. So first of all, you got that going for you, which is nice, as they say. And then secondly,
especially if you think inflation is overstated.
And exactly. And I think the second point is, a corollary to that is, if you think that the next interest rate move is more likely to be down than up, or the next crash is more likely to be deflationary than inflationary, which historically has been the case, then you want to own bonds as a hedge and a store of value, so that when stocks get hit in the next correction, crash, whatever. Hopefully it's not soon, but in that next period, then you want to be in bonds. And certainly I think that this is a good time to be allocating there for clients. I think corporate spreads are tight. I don't think that really helps you right now because you're just adding corporate exposure on top of equities, which kind of defeats the purpose. But I think clean, super clean credit bonds, munis, treasuries, mortgages are good places to be.
Yeah, mortgages are still cheap. Mortgages got popped and they haven't come back. And, I mean, treasuries gotten popped and they've come back a little bit, mostly on the front end of the curve. I mean, it's one of those things where it's counterintuitive because suddenly everyone's like, oh, I got to get into stocks. The time to get into stocks was 3 weeks ago. Mm-hmm. And the time to get into bonds is now.
Yep. And
you need to be riding that asset allocation. If you're 100% equity, it doesn't matter. But even if you're 90-10, you've suddenly seen a double-digit increase in the stock market. The S&P 500 is at 7,100, or it's about to open there. That, to me, means that the higher a price goes, the more risky the stock is. I mean, that's just, it's counterintuitive, but, if you're at 1 penny, how much are you going to lose? You can lose 1 penny. If you're $1,000 a share, you can lose $1,000 a share, which is why shorting never works, because the opposite is true. One side is bound by zero and the other side is bound by infinity. And so the idea is just continue to be smart. If everyone is talking about, man, I got to get back in on NVIDIA, which is rallied, or Oracle, which has been up double digits multiple times in the last couple of days, it's actually counterintuitive, but you should probably be thinking it went down for a reason. That reason didn't change. Claude is still out there. I should take those gains and I should move them to something where I'm guaranteed a positive real rate of return over a falsely calculated high inflation rate. And you can get, call it 2/3 of the historic return of the S&P 500 in something that is AAA. And you can lock that in for 30 years if you choose to do so.
Netflix this morning is a great example of this. The stock reported earnings, fine earnings. They provided guidance, reiterated guidance for the year. There was a little bit of concern that maybe analysts wanted them to raise guidance for the year because they no longer have the expense that they would go through with lawyers, et cetera, investment bankers, to acquire Warner Brothers Discovery. So there was a little bit of concern about that, but the stock's down 10% pre-market, and this is entirely due to the fact that sell-side analysts have talked up the stock for the last week and a half, saying that they're going to be so profitable because they're not having this. They're going to get right back to business. The stock broke out above $100 a share. It had been pushing up against that. Goldman popped the stock all the way to 108 because they upgraded the stock, and now everyone's sad that it's back to 98 where it was like 3 days ago. And what was it the best news of a quarter? No, but it wasn't, cataclysmic earnings that should take stock down 10%. But the reason it's down 10% was because expectations, that pendulum that had been to gross negativity when they said that Netflix was blowing all this money buying Warner Brothers Discovery and that they never make money, and it was $74 a share. I mean, you priced all that. I mean, it ran from $74 to $108 in like a month. So this is why, to your point, Tom, it becomes more risky when it gets higher. Now, we have a lot of gains, some short-term gains on that too, so we're not going to try to time every move and trim every bounce. But we're not going to freak out about this, and actually we probably might be interested in buying here. Now we get it 10% cheaper. I mean, it's like, red letter day. It's on sale. So that's how we're approaching things. And the thing is just not to get swept up. This is a analyst-driven decline today, just as it was an analyst-driven rise in the market. And I think that, it's very important to be cognizant of where sentiment is and be able to attack when others, or tick when others talk.
Yeah, it's just interesting because, I mean, you just gotta cut through the headlines. Oil was never going to go to $200. Mathematically, didn't make sense, and so you had to look around and say, okay, well, what do we do here? A lot of that was maybe we trim Exxon and Valero when we buy Oracle. Mm-hmm. We don't think that most of these software companies are going to zero. Many of them are going to continue to exist, but the hate and the negative sentiment just piled and piled and piled. And then eventually it just went away. I mean, they're saying now potentially these could be enhanced by Claude as opposed to destroyed by Claude, and now suddenly they're hot stocks again. So the narratives change really quickly. And honestly, I don't know that that's still true. But the difference is, if you buy it cheap and now it goes up, you've got a lot more wiggle room now to make decisions.
We have a lot of economic data next week, or not so much economic data, but some economic news, including the Kevin Warsh nomination or confirmation hearings. I want to just kind of quickly put a button on the data that we got this week. We did get surveys out of the Empire State Manufacturing Index, which we discussed, and we also had the the Philly Fed Index, which has a very high correlation to the ISM Manufacturing Index. You put those two together, and the ISM Manufacturing Survey is likely to increase from 52.5 or so to well above 54, maybe even 55 or 56 in the month of April. So we're seeing a sustained fundamental economic improvement on the manufacturing side of the economy that's completely going unnoticed. And by the way, that's happening with oil prices 30% higher than they were just a couple months ago. This is a very sustained trend. We're seeing investment banking activity continue. It's not slowing down. And I think that this is really good news for the economy, because I think if we get some relief on the geopolitical side, people see this as an opportunity right now. They see AI as an opportunity across the board. They see actually reshoring as an opportunity across the board, and they see consolidation as an opportunity in accelerated by AI, because now all of a sudden you can combine two businesses and you can more quickly get people on the same tech stack, which is an extremely costly integration. Anyone who's consolidated ERP systems or moved ERP systems understands that that is an incredible impediment to any deal and the success of any deal. And now we're seeing that some relief there. The other piece of that is, I think that people who want to do mergers want to get them done perhaps before the midterms, in case the antitrust regulation changes a little bit. And I get that's more of a executive branch proposition. But the ultimate takeaway here is that the economy is doing well. But here's the thing. There's not demand pull inflation going on, because money supply is not there. Average hourly earnings are as low as they've been since, I think, March 2021 on a year-over-year basis, and that's even with the net outflow of jobs. So average hourly earnings down on a per person basis. And then we have there's cost push inflation perhaps, but that should already be embedded in the price, because we've had tariffs for a year and we had oil prices that should have hit last month. So I think about inflation, and I don't see that really moving all that much, maybe even going down. And then I think about the economy doing well, and I think this might be a really good time for someone like Kevin Warsh to come in. And so, Tom, we have the hearings next week. I imagine you're going to be watching that very closely. What else are you going to be watching? Maybe some quick comments on those confirmation hearings. We'll talk more about it next week, but then also some of the news that we'll get next week on the earnings side.
I mean, I'm interested to see how they go. I suspect that there's a lot of chatter now about everybody standing tough against Kevin Warsh. I suspect that's not going to be as aggressive as they say. I mean, we got a lot of that with RFK, with Tulsi Gabbard, with all these different people being put in cabinet seats. They're like, man, we're going to fight these. We're going to delay them. We're going to do all this stuff. I think ultimately it doesn't go that way. It didn't go that way the first time. Tom
Tillis in the Senate, he's not a grandstander. I mean, he might be pushing it back against this, but he's not going to grandstand.
But like Tim Rose has been putting out all these articles about, what happens if there's no, Fed president, if there's no way that, does Jay Powell stay on? There's stuff with the Carter administration and Reagan administration where there's no clear precedent set on like how that can go, who's going to be in charge if Jay Powell stays on, but Kevin Warsh doesn't get confirmed. I think that's a lot of just dirty diapers. I think it's just they're trying to sow seeds of doubt and, try and get the narrative towards Warsh is going to be a bad choice. But in reality, I think he's a good operator. I think that if he's tight with Scott Bessent, then we're in good hands. And, hopefully we can just get it pushed through. But I don't anticipate it being a whole dog and pony show, but it's certainly a possibility, and they're definitely trying to push it that way. But I just don't think that most of these people are really all that bought in.
The thing is, Kevin Warsh is calm too. He's going to get pressed in the Senate by at least one senator that I know of. about how dare he have $190 million by marrying the heir to the Estee Lauder fortune. So he's going to get pushed on that. He's not going to bite. That's just not his personality.
Yeah.
He's kind of, at the end of the day, he's pretty bookish.
Yeah. I mean, nobody goes after John Kerry for marrying the heir to the Heinz, ketchup heiress. You know, I mean, this happens all the time. I once had a client say that the easiest way to make money is to marry the right girl. So he's like, you can make more money in 5 minutes than you can make in a lifetime. So for all of you young boys listening, that's probably good advice. You know, whether you choose to accept it. So the tough part is getting in those circles, at least in my case, you know. So shout out to my wife. She's wonderful, and we'll make our own money. Our daughters will be heirs to our great wealth. So we'll make some young man very happy one day. So,
all right. On that note, have a great weekend. Enjoy the beautiful weather out there. It is springtime here in Marietta for sure. And we will see you on Monday.